All right. So tonight we're going to talk about personal loans. Um, a lot of times there's, reasons you may want to take a loan for different reasons. If you, um, you know, need money this is not necessarily for a home in this case, not the type of loans we're talking about. These would be for other items, might be for a vehicle, and sometimes there's just personal cash loans, but we'll explore the different ones. Um, Finance a large purchase, financial institutions, banks, savings and loans, and obviously it's going to be any of these are going to be pretty formal. You can also go about friends and family and things like that. But I'll tell you the truth, I don't typically take any of these personal type loans, and I would argue that the strategy I use is kind of whatever. I've talked before about taking loans against your retirement money, your retirement savings, which is not a bad way to go because you pull the money out and then you pay the interest to yourself. So they really don't explore that here in this chapter, but I'll uh, show you some examples. There's also some of this peer-to-peer lending. I have friends who have done this in terms of investing, putting some money down with some of these people. But again, if you're trying to be in business, if you're taking out a loan, and that, I guess, I'm looking kind of short-sighted, but that's usually why I would look at taking a loan is to expand a business. And it's tough enough to make money in business when you have a lot of debt. And I don't know. I think I'm pretty capable in terms of deciding what business ventures are going to work, but sometimes I get them wrong. And I really don't want a whole bunch of debt. So anyway, the statistics kind of bear it out that you know, especially like on some of the high tech stocks and things like that, of those super high tech, 9 out of 10 fail. I mean, it's not good. I would think that you do better on your own. You might not be in such a high tech venture. You might be looking at a normal business or whatever reason you're going to do it. But that's kind of what these guys specialize in. And I get their mail all the time. But yeah, I don't want the stress of that. But anyway, peer-to-peer loans, it's what, these are like from friends of mine where they'll invest a certain amount of money. And then on the other side, there's, consumers or people with businesses and they borrow money from them. And it's just sort of takes the banks out of the picture. And for the people who invest the money, what they do is they split up their funds that they give to these companies into very small chunks so that their exposure is not that great. They've got a whole bunch of different sort of micro loans out there. The person on the other end, the consumer or the business, they may have a rather large loan, but it's made up of a whole bunch of different small investors. So it gives some diversity. But anyway, they just sort of mention it in here, and I guess it is getting to be a bigger thing now. But the problem is that, like I've said before, banks are not really that keen to loan you money for unconventional stuff. Getting a home mortgage, easy or relatively straightforward, or a car loan, something like that. But business loans, that's difficult. Periodic payments, so sacrificing future earnings. So, like, especially like for a car loan, if it barely makes sense when the car is brand new, and you really are eager to pay for it and it has no maintenance costs, that's one thing. But if you're still making payments and it's older and you're kind of tired of it and it's got maintenance bills, you have to think long term. Some of these documents we talked about before, balance sheet, cash flow statement. So that's kind of what they would ask to see. Now they would probably have you plug all this into a computer, but it would be nice to have those forms or kind of, know what data needs to go in there so you can fill them out quickly. And also just for your own use to kind of know what you can afford. Amount of loan and the interest rate is going to be the key items. Am- Amortization schedule, amortize, that just means, a series of equal payments. So, if you've got a 6-year loan or a 30-year loan or whatever, that would be the number of payments are going to be made throughout the course of that, and principal and interest. And then, like I said, on long-term loans, the proportion of principal, which is actually the amount of the loan, and the other part of the payment, which is paying the interest, those will vary through the course of the loan. And so initially, you're going to be paying almost all interest and very little principal. And then towards the end of the life of the loan, you'll be paying almost all principal and very little interest. So anyway, maturity of the loan, how long it's going to take. So there's different reasons to do that. The standard in real estate is a 30-year loan, but some people opt for 15. I At one particular time when I was in Europe, I just wanted to do a 10-year because I just wanted to kind of have it down. Plus, I had a huge down payment. I'd sold some other properties I had and put down, a whopping down payment. So I just wanted to finish. But anyway, they'll typically um, work it out. But for comparison's sake, uh, by far the most popular is the 30-year fixed. Collateral. So we mentioned this before. This is, a collateralized loan, a loan that's backed up with assets will get you a better rate. And so you can also refer to that as secured or unsecured. So secured is something that's got something behind it that lender can take if you fail to pay. And an unsecured loan, sometimes you'll hear that called a signature loan. Just there's really nothing to back it. There's also a concept of co-signing, which is, I would very much advise you never ever to do this. What happens is somebody with, you know, arguably crummy credit can't get a loan. And so they come to you, a friend or somebody, and they ask you to co-sign the loan with them, and that way they can get the loan. Well, if somebody was to do that and I was inclined to give them the loan, I'd rather just put the loan in my own name and they can pay me. But once you co-sign a loan, what could happen here, and I'd say argued likely to happen, is that the person who didn't qualify the loan is going to have a tough time paying it back because obviously their income wasn't such to qualify for that loan. So they had to get a co-signer. So let's say they fall behind on their payments and all of a sudden that, loan goes into collection. Well, like I say, these things get turned over to collection agencies, and when the collection agency is presented with this loan, they've got all the rights to go after the person who took out the loan, and they're not going to mess with the person who originally got the loan. They're going to go after the cosigner because you know that the originator of the loan lacked the resources to qualify for the loan, but they also know that the cosigner, the person who qualified that is going to has the resources, and what's probably going to happen is you could have probably taken care of that loan and got on some sort of schedule, but since it's gone into collection and since you were the cosigner and probably had some sort of delayed reporting, this thing may just kind of blindside you. So anyway, not a lot of good reasons to cosign. Um, Loan application, largely now it's social security number so they can get that whole credit report, and then do you own a rent and your income. Um, all these other assets and liabilities kind of nice to have, but liquidity really comes in to be an issue. I've got whatever amount of some sort of investments or something, or even real estate. It's just time consuming to turn real estate back into cash. Liabilities are pretty clear cut. Um, your creditors probably know exactly what that is. And then APR, annual percentage rate. Talked about that before. It's just a standard rate that allows you to make comparisons. So there may be differences amongst the lenders. They'll have different interest rates, but they also have, perhaps different other fees and expenses and different terms. There's just a lot of moving parts. So it's not always the lowest interest rate, but it typically is. Typically, the lower interest rate is going to be associated with a shorter term loan because there's less risk for the lender. there's less time for the interest rates to change drastically. Um, but with real estate loans are cheap, and we'll go through some of the charts. Real estate loans right now, especially, are very inexpensive. This was this concept where I was telling you about this loan. So this isn't a real estate loan. The numbers are quite a bit lower, but anyway, they owe a couple grand here. And at first, um, the interest rate on here is $20, and rather I should say the interest payment's $20. So the rate is set, but the amount of your payment that's going to interest is $20, and the payment towards the principal is 157. And then here at the 12-year point, the interest portion is quite low and the principal is quite high. So um, personally, I would use the 30-year loan. It's quite a bit more dramatic. But anyway, the concept's the same between the ratio of principal and interest. What is kind of interesting though from a tax perspective is when you get down here to the end of the loan, let's say, the end of a 30-year um, home mortgage. And the reason I'm saying a home mortgage is because this interest on home mortgages is tax deductible. So sometimes you'll hear people say something about, they may want to buy something new or bigger or whatever because they want to take advantage of a larger um, tax deduction. Granted, they're taking out a bigger loan, but anyway, it is true that as the loan ages out, the amount of your interest being paid is quite a bit lower, and therefore the amount that you can deduct on your taxes is quite a bit lower as well. Um, how much can you spend on a car? I don't want to be Debbie Downer here, but I keep telling you that, you know, you should spend what you absolutely need to and not really what you want to. Um, there's all sorts of assets um, that are depreciating assets and then appreciating assets. And so I would never, in terms of a home, I would look for something in a neighborhood that's going to go up and in a neighborhood that's improving. And I probably encourage you to spend more on the home. But on um, cars, they depreciate. They go down in value over time where a home does not. So anyway, it is tempting though, because it is, you know, a lot of advertising, a lot of things going on. A lot of people tend to judge each other based upon what they drive. Selecting the car, personal preferences, price, condition, resale value. Edmunds, some of these things, there's Kelly Blue Book, there's Edmunds, there's all these other things, and um, they used to be fairly objective. Now they're kind of in cahoots with the car dealers, so they're not very effective. And they're also based upon sample sales, and in Alaska, prices and everything. These books just really don't work up here. Repair expenses, financing rates, and loan contracts. But anyway, I mean, resale value is certainly important, but there's certain vehicles, maybe Toyotas, maybe Subarus, that tend to stay up. And then there's kind of broad classes. And to tell you the truth, anything that's luxury oriented tends to drop like a rock. And things that are ultra performance oriented, like a sports car type thing, um, anyway, I'm just saying from personal experience. I had a Viper that was worth more now than when I had it, and similar price, at least going in, was that one of the Jaguars. It was a sports car as well, but much more on the luxury side, and it's continued to go down in value. Uh, anyway, the personal preference over which one you like, but Cadillac Escalades and things like that tend to drop like a rock as well. So this KBB is Kelly Blue Book, and again, these things kind of had their time and place, and it's really difficult now because they don't seem to be very representative, especially in Alaska. And part of that too has to do with Alaska being a non-disclosure state. People in other states where they're charging you sales taxes on all kinds of items and private transfers, um, by law, you have to report the purchase price in Alaska now. So um, obviously, if the state had all that purchase price information, they would probably either give it or sell it to some of these vendors. But that is not even available. So these guys are just guessing, or they're doing things for the lower 48. Or like I say, a lot of times now you find that um, the car dealers themselves, there's only a couple big car dealers, and they're they have their hooks in with these folks as well, and they tend to set the prices, and it's not good. Um, Rolled the wrong way. Sorry. So she's buying a car. She's looking at all these different things. Um, Again, trucks probably tend to keep their value a little bit more. But again, you'll know, and I'm not trying to make this a car kind of thing, but it is a pretty large purchase. Do your homework, and certain cars. If you look in the used sales, even if you're buying new, look at some of the used cars, and you'll see that certain brands tend to stay up there. Um, I was looking at an old 4Runner, and they just don't get that cheap if they're in decent shape. Whereas, the equivalent, the Nissan Pathfinder is quite a bit cheaper. So anyway, negotiating the price anymore, especially if you don't like going to car lots, you can use the internet. Trade-in tactics, yeah, definitely. If they know you're very concerned about the price you're going to get for the trade-in, they'll offer you a whole bunch for the trade-in, but they'll keep the car price high. Or if they know you're, want to negotiate on the price of the new vehicle, they'll lower the price of that, and then they'll give you nothing for the trade-in. So I know it is painful, but private party sales of your vehicle are probably going to do the best. And this whole no haggle thing, it really is for who? I mean, they say that that's a benefit to the consumer, but um, it's not like you go to a car lot and you haggle with them and the price goes up. It's only going to go down. So, um, anyway, information is valuable. Purchase a car online if possible. Going out of state is possible as well. But then you have to look at some of the shipping costs, but you can work around that. But anyway, now with all the information that's available to you on the internet, you should, you know, be able to keep from getting ripped off too bad. Monthly payment. So that's one of the annoying things where you walk onto the car lot and they're like, "Well, what do you want the monthly payment to be?" And you're like, "Well, I'm concerned about the overall price." "Oh, don't worry about that." And they'll just keep pushing out the monthly payment until they get down to the level you want. Now you're financing a car for 6 or 7 years. The car may not be holding up like that. When I was in Spain, they were taking mortgages out to 60 years, well beyond the life expectancy of the person taking the loan. So it gets kind of odd. Um, Cars may be worthless. Yeah, there's just not a whole lot of resale value on most of them. But people do tend to keep cars longer than they used to. Um, Here she's looking at the different payments, and you can see it does go down over time. But you'd have to see also what the interest rate is. It would be kind of odd for the interest rate to stay the same over each different period. Leasing, popular with some, but that's not typically a good alternative. If you do have some unique business situation, but I've done a lot of different business things, and I've never encountered a situation where the lease was cheaper. They typically will advertise those like BMWs and things like that, or Mercedes with a very low lease price, but there's a little bit of money to get in, and then there's a chunk of money to get out, and you're really just sort of renting the car on a long-term basis. So excess mileage, wear and tear, things like that all tend to cost you. Disadvantages of leasing: you don't own the car. You're responsible for maintenance and damages, and then the extra charges that may occur. But some people just hate selling their own car, and they always want to have a new car. And anyway, that's what the car companies would love. They would love for you just to suck it up and say, "Yeah, I'm going to pay, I don't know, 600, 700 bucks or more, every month for the rest of your life." And anyway, y- you're far better off to have something paid off or a lower payment and use more money to invest in something that's going to do something for you. Student loans, this is changing a bit. Um, the federal government owns the student loan program now. But there can be deferments too, certainly, going in the military, teaching at certain schools, working for certain public sector um, organizations may result in a deferment. So that is a definitely something to check into if you think you're going into one of those careers. But for the most part, try to keep your student loans low. It's not, you know, just that the student loans can be quite a bit of debt, but it's debt that occurs at that time in your life where, your late 20s, early 30s, where that money would really have a chance to work for you right as you got out of college, and instead you're paying off loans. So, home equity loans. The reason why people would do a home equity loan is, well, let's say you have equity in your home. So let's say you bought a home for, 300 grand, it's worth 400 grand now, or you paid down on the loan a while and you've got $100,000 in equity. And if you take a loan against that home equity and you use it for needs that are related to the home, it can be tax deductible in the same manner that a regular home mortgage is. So, um, 80% of the equity. So let's say we had 100,000 in equity, you get a loan for 80 grand. Um, yeah, if the market's zooming around, it can definitely change the amount that you can loan and the interest rate. And here they talk about the tax deductibility of it. Payday loans, things have gone horribly wrong. You're taking a loan against your paycheck, and the same sort of loans are like when a Liberty Tax or somebody like that says an instant refund. The IRS doesn't work on an instantaneous basis. You're taking a loan against your future tax return. But anyway, those types of loans typically have pretty high interest rates, and it's fairly drastic. Not something you typically want to get involved in. That's for for folks who don't have a good handle on their finance and are going to be paying outrageous sums for their financing and end up in the same situation. The one item I wanted to talk about real quick that, again, the book doesn't address um, was the concept of loans against a 401k. So let me just show you a couple things. There's different, uh, investment things out there, but what you do on a 401k. A 401k, we haven't discussed them in great depth yet. I mean, I've alluded to it a little bit in the taxes. But if you're working for a company, or there's also schemes like this that can be used for self-employed, or maybe you're working for a nonprofit and you're gonna have a 403b, which is the same sort of scheme. Anyway, this is called a tax deferred investment program. So in my example, I always use an income of 100 grand, and you're going to be pretty aggressive here. You're going to dedicate 20% of your income to invest in your retirement. And so if you do that, use a 401k or one of those other tax deferred vehicles. What you would do when you go to file your taxes at the end of the year, your taxes would equate to somebody who makes $80,000 a year. That 20,000 that you put in the tax deferred retirement, that will not be taxed until you withdraw that in your retirement. Um, Actually, you can start going after it at age 59 and a half. So, um, but anyway, that's where typically you're going to put a large chunk of your retirement savings in a 401k or a 403b or what have you. And when it's locked away in there, there's penalties if you touch it before you reach that age. Like if you have 50 grand in there and you decide you want to take $10,000 out, well, the IRS, because you took it out early, will charge you a 10% penalty for taking it out early. And then they'll also make you pay the taxes on it right then in that current year. So it can be a pretty expensive proposition. But there are ways. Now, there's hardship withdrawals that you can do from your 401k. And some of those hardships are not that, you know, hard. They're, first time home buyer perhaps, or depends on the program, depends on the year. But sometimes there's qualified medical expenses where you can get at that money. So it's nice. It's a big chunk of money that's working for you that you also have access to in case of one of those hardships. Now, what I'm going to be talking about is just taking a loan against it, borrowing from your own 401k. And this doesn't involve the IRS at all. They really don't care. I mean, there's no paperwork. You're not taking money out of the account per se. You're just sort of shifting it around. And so typically, COVID's changed things a little bit, but typically you could take up to 50% of your retirement account up to a maximum of 50,000. For this year, they made it up to 100,000 bucks. So when you take that money, you get a check, and literally you get that check within it's less than a week, and it's originated with a phone call, and there's no credit application because it's your money and you're just transferring it around. So it's dead easy. I mean, I literally did this, driving to work one day, and the check shows up, and I do this, so I've probably done it 6, 7 times. But anyway, you typically pay it back over the course of about 5 years or shorter. You just set the terms that you want, set the amount you want. I've never taken a big chunk like that, but I needed some equipment for my business. I needed, let's say, 18 grand, I think I pulled, and I said, I'll just pay it back over the course of 18 months. And it was dead easy. No banks, no anybody. Now, I do pay interest on that loan, but the interest is paid to me. It goes back into my account. So it's really kind of a no-brainer and something they don't talk much about, but I certainly do it. Now, here's another, article. So you can find quite a few articles. People know a little bit about it, but they don't often recommend it, or they think you don't have the discipline to pay it back, or they come up with some, dire situation. And I'll tell you what, one dire situation is if you get fired or you quit your job. It's typically your 401k is typically tied to your employer, and quitting or getting fired may require you to pay that loan back in full when you're leaving that employment. I've never gotten that situation, and I don't know what the ramifications would be, whether there's any grace or anything. But that's one of the downsides. But I've never encountered it. Anyway, just people use them for a variety of things. Especially this would be one of those situations where you have some credit card debt that's eating you alive, and you don't want to take out a conventional loan and start paying interest to somebody else, or medical expenses, taxes, education expenses. Now, if you lose your job, here they go through the details. Yep, repay the outstanding balance. So, anyway, um, I've never had that problem. And you're not really missing out. The money comes out, it's out of the market for a little while, and then as you pay it back in, your funds build back up. But anyway, I spent enough time on that. Let's look at financing a home. So, um, 10 to 20% down payment can vary. You know, I typically have not, well, on military stuff, um, you know, some people have that and they'll, you know, not have to put down that down payment. They can finance 100%. Um, but it can vary. You can put down much more if you like. Like I said, I put down 1/3 to 50% if I wanted to, just based upon what I was trying to do with the loan. Typical are fixed rate 30 years, meaning the interest rate doesn't change over the course and it goes out for, what would that be, 360 months. This part here, some of these calculations they have, no more than 2.5 times your gross annual income, just because the real estate markets between different locations are so, you know, so extreme. These monthly mortgage and if you're living in San Francisco or Palo Alto or some big city like that with high prices, you're probably not going to be able to pull this off. Whereas if you're living, someplace in Iowa or Nebraska, so anyway, these numbers aren't really nationalized. Um, but you do find people, and you'll meet people who are kind of slaves to their home. They may have a nice home, but they can't afford to do anything else, which, you know, isn't necessarily bad because it means they're definitely max performing and they're putting all their money into an asset that's appreciating. That's good, but the fact that they aren't really able to do much or take care of it even, yeah, you can go to too far of an extreme. Affordable down payment, and then closing costs in here. There's a lot of startup kind of costs when you're buying a home. Um, I have well, I've let it lapse, but a real estate license here in Alaska. And anyway, there's customary charges that, appraisals and things like that. Appraisals, that's a buyer's cost, and the commission, that's a seller's cost, and there's a breakdown. But we're talking typically in the range of about 10 grand of extra charges that are split between the buyer and the seller, but that's for a medium kind of house in the $300,000 range. That's probably it. Whatever. It's yeah, it's always been about 8 to 9, 10,000. So affordable monthly payments. Yep. So your cash flow statement, you should kind of know what you can afford. The big thing, if you're looking at buying a home, um, is find a lender that you want to use. If you may find a salesperson you want to talk to, you may have somebody in mind, but if they're a good salesperson, they're going to tell you to go talk to a lender. Now they may direct you to a lender, which is fine, but a salesperson who, an agent, if you want to call them that, who shows you a home when you're not pre-qualified, when you haven't been to a lender, you're just wasting everybody's time, and it's just kind of what you sort of display is just sort of a non-serious attitude because you may not be able to afford the homes they're showing you, or you may be able to afford something much better. But it's kind of the lender's call because you've got to get qualified for that loan. So all these discussions are kind of academic because it's not your personal opinion of what you can afford. I mean, that is part of it, but um, the lender will also have some constraints on the high end of what they'll allow you, what they'll loan you. So, um, don't go for the maximum you can afford. I always approach it, but yeah, may not want to go above it. Don't buy above what you can afford. So again, they're saying that home values don't always rise over time. Values can drop. So this book, what they're kind of reflecting here is the drop that happened in 2007, 2008. Anyway, that was a time where people had multiple mortgages and they thought the market could never go down, and most rational people knew that there was a bit of a bubble out there, and some of these, you know, people that had no business owning five homes, and they really didn't own five homes, or they had them, but they were never intending to pay them off. They were just going to flip them. That was just a house of cards. So I would not be that paranoid about home ownership. It's one of the most secure purchases, but and again, it depends on the market. Um, again, certain places, Miami Beach, Phoenix, Las Vegas, they tend to have these very volatile markets where this does go up and down. But a place like Alaska, probably not so much. Whoops. Single biggest investment, typically. Pardon me. Price range again. Getting pre-qualified will help you with that. Identifying the home you want. This is also where a good agent can kind of help you out. Um, you kind of have to buy a home with the intention of selling it. What if you had to sell it right then? Is it a desirable home to other people? Pardon me. Anyway, and cost of renting, cost of buying. I've talked about that a little bit. There are some differences. There's, um, a lot of tax advantages to buying a home. There's a lot of lifestyle things where you can do what you want with a home. But if you're going to be moving quite quickly, or if you don't have the money for the down payment, you may have to rent for a while. But over the long term, since it is such a big investment, real estate is a wealth builder where renting is um, probably not a long term personal finance recommendation. Condominium, not a big fan. Problem with condominiums, especially up here, and I think it's probably nationwide, is condominium associations. And on a condominium, what you own, you own everything from the paint of the home, the paint of the apartment inward. So you don't actually own the structure, you don't own the grounds, the parking lot, all that other stuff. None of that's yours. You're just from the paint inside, so the carpet and all the fixtures. But the reason why I'm kind of down on condominiums is because I've been in this situation where you've got somebody who wants to sell a condominium and it's not going well. The condo is not selling. And so they say, well, I'm just going to rent. Well, many of these condominium associations have, policies that you signed up with when you joined, HOA type things, homeowners association type things that say there can only be a certain number of rentals. And so if you can't sell the condo and the condo association precludes you from renting it, you're in big trouble. So you don't typically find that with single family homes. You may want to sell, you may want to rent, but that decision is yours. It's not forced upon you. So plus condominiums are not too terribly different than an apartment in terms of your personal space, but that's definitely a personal decision. But some of the associations I just think are more onerous in the condominium section. Real estate agent, um, there's all kinds of different folks who get into that business, and if you're buying a home, it's pretty much a no-brainer to at least talk to an agent because the seller pays the commission. It doesn't cost you any more to buy through an agent. The other issue is that if you see like a for sale by owner or something like that, and you think, oh, okay, this is going to be cheaper, I would argue that often that's not the case. What typically happens, and I've done this before, somebody wants to sell their home, you go and speak to them, they want quite a bit of money for it, you do a market analysis, you explain to them that your home will never sell for that, and they get a bit insulted and they say, oh, fine, I'll just sell it myself. So they'll put it up there for that price that they wanted, which a lot of times is not competitive. So online services, This is kind of the way of the future. I've got a couple stocks that have done really well that are some of these um, companies that are getting involved in this and more of an internet thing because when you get right down to it, the real estate agents do provide a service. Most of them do, but um, the the fees that are charged and just all the expenses they generate may not be. I mean, 6% is a lot of money on a big transaction, and most of them earn it, or at least they pay it away in all kinds of little piddly fees. But sometimes you know exactly what you want, you know where it is, and you know the agent is just taking 6% for maybe not doing as much. And other times they're valuable. They can keep you out of flood zones or make sure the inspections are done properly and make sure the transaction is on the up and up. But not all the agents are that good. Um, Criteria, so obviously price, location. Location is definitely important. Maintenance, schools, even if you don't have kids. Insurance, mm, taxes, they're just taking a wag here, but taxes are significant, especially, if you look at someplace between like the Matanuska, which is considerably cheaper, and Anchorage, which is considerably higher, and homeowners associations. There's good and bad. Um, I'm not a homeowner association person, but again, if somebody wanted to build a purple domed house next to me, there's not a lot I can say about it, other than just having a lot of property and making sure they're at least a quarter mile away. But anyway, it's a personal decision. Resale value, yep, a commission, it's going to be paid, and personal preferences. But again, just look at all these factors um, as if you were trying to sell the home quickly. Is it a desirable home? Is it in a good location? And the schools and the rest of it. Schools can change over time, but um, and then also reputations. There's some intangible things where people will not want to be in certain neighborhoods because they're like they've heard about the homeowners association in that area being bad. And in Alaska, there's just a lot of other factors. I mean, I've looked at some look great online, lots of acreage, and you come to find out they're in an avalanche zone or they're in the shade, whatever number of months out of the year. So a lot of different factors. Market analysis. So what they use is comparable sales. But this whole usually based on price per square foot. I'm more interested in the size of the overall property, not just the square foot of the structure. So, you know, 3,000 square foot on a half acre lot is one thing, and 3,000 square foot on 10 acres is a difference. So it's oftentimes when you're getting into property and different size homes, it's often difficult to find comparables, comps. So obtain from broker or appraiser. Typically, a broker can do that. Appraisers, you'll bring them in, but appraisers, again, it's kind of a false sense of security. The appraisers know how much you're taking a loan for. They have access to that info. So guess what? The appraisal usually comes in what the bank needs to be, unless it's a extreme circumstance. But almost always, you'll monkey around with the price and you'll go up and down and you'll finally come up with a price, and then when the appraiser looks at it, it's miraculous. It comes in with a couple 3,000 of your price, and it's just kind of curious. Um, yeah, I think the going rate, like in a place like Eagle River, is about 155 a square foot. Those are numbers from a couple years ago, but again, I'm not so much on the square footage. I do want to know what the numbers of square footage are for rebuilding a home for insurance, because that's a scam they'll play on you. They'll say, Wells Fargo did this to me. They sent me a thing saying, "Oh, you're underinsured. Your home's worth say 400 grand or something, and you only have 300,000 of insurance." And it's fairly transparent. I said, I'm the land's not going to burn up. The structure to rebuild the home was a couple $100,000. So that's the only thing that can be damaged by a fire, flood, whatever. The land will still be there, and they finally backed off. Economic times. So yeah, right now it gets deeper than this. Interest rates right now are super low, and because of that, there's more demand for housing because more people can qualify for a home. When the interest rates go way down, your overall payment, because it's such a long-term loan, the payment goes down. So it's interesting. So it's all about supply and demand, a buyer's market, a seller's market. Yeah, they keep talking about the financial crisis. So it just sort of dates the author. There were a lot of defaults. Things did drop. Um, Loan procedures became slightly more difficult, but it probably will not happen again. And it's not necessarily due to government intervention. It's just an understanding by people who thought home prices could never go down, that there was no reason not to have, multiple loans and be millions of dollars in debt in real estate, on all these separate mortgages. And anyway, that's just not the case. Zoning laws, yep. Again, this can change things. If you have some zoning law that allows an industrial structure to go right next to your home, that can be a bad thing. Um, Second opinion on your valuation. Anyway, you need your own salesperson. To rely on somebody else is you need somebody with a fiduciary interest. We talked about this, 10 to 20%, but can change. PMI, private mortgage insurance. That's what happens if, let's say, you can't make the down payment. They're still willing to sell you the home, so you know put down 15%, and they'll charge you uh, a PMI fee until you your home either increases in price or you pay off enough of the loan. I did this one time, and for some reason there was a home bought in Las Vegas, and it the market was just booming at that time. It was a scary market then, and as it is now, but at that time it was definitely going up, and I lived there. I needed a place, and bought a home and paid PMI, and like 3 months into the purchase, I had the house reappraised, and they said the value had gone way up, and all of a sudden I could add that equity, claim that equity as part of my basically my down payment, and now I had enough equity in the home where I no longer required PMI. And it was about, I think it was 100, 120 a month of PMI was paying, so it was nice to be done with that. Closing cost, all these little things, and I said, literally about 10 grand, because that's what happens. Appraisal fees, home inspections, well and septic, if you've got that, you've got other fees, you've got loan origination fees, you've got all these different fees that fee upon fee, and then when you move into this home, you start, going to whatever one of the big box stores, and all of a sudden you need garden hoses and things for your refrigerator, and it just so that's expensive to move into a home, especially when you want to set it up. Fixed rate mortgage, and we used to have, they keep talking about fixed rates, but they're not talking about the others. Adjustable rate mortgages would be the alternative to a fixed rate. So adjustable rate mortgage would change over time. It's a little sketchier. Again, I've done it, and man, I paid a very low interest rate, and I got in and out of it before anything bad happened. But it's can be a sense of risk. Amortization table. Again, amortization is that series of equal payments, and the amortization just tells you that interest and principal, like we were talking about. So here's what they're showing, and this is what I was talking about on a larger scale, 360. So that's 30 year, and so in this case, the payments always 537, but at first just paying a little bit towards the principal. At the end, all but you know $3 of it is principal, and $3 of interest at the end, and 417 of interest. So this is tax deductible. Here at the end, if your goal is having tax deductible investment, do that mortgage insurance. Anyway, the real estate taxes will still be tax deductible, but the interest is petered off to almost nothing. That's a no-brainer. And the larger interest rate, larger the mortgage payment, obviously. And again, their principal and interest paid over the year. One more time. But that's what happens. Obviously, if just like in a vehicle, you finance it for 8 years, the payment's going to be lower. In real estate, it makes more sense, but it's the same concept. Again, so they're acting like 5% interest rate is kind of normal, and it's considerably lower now. I'll show you in just a second. So something like Bankrate or one of these websites. Oh, Bankrate is the one they're using. Good. Characteristics. So you can see what happens to the monthly payment as the interest rates go up. When I say that the interest rate has a big effect, I mean, they don't even get down to 3% where we are now, but you can see this difference in rate between 4 and 8%. It doesn't quite double the price, but it definitely makes it, in the range of unaffordable, because this is only based on per 100,000. So a $300,000 home, you go from roughly around a $1,500 payment to roughly around, I don't know, 2,200 payment. There's a lot of people who want to press and make double payments and get it done in 15 years. Fair enough. Um, Me, I would rather perhaps have a second property. If I can afford to make double payments, I'd rather stick with a 30. But anyway, it's up to you. Now these great deals on deductibility, they apply on owner occupied. You're not going to get those low interest rates on investment property. And so that's kind of like the problem I've got right now. I've got a one home that I still have a loan on, but I got the loan when I was owner occupied, so it's relatively low. It's not competitive in today's market, but if I want to refinance it, I have to refinance it as an investment property. And so the interest rate would probably be up around 8%, not the 3% that a owner occupier can get. Adjustable rate mortgages, so these ones will change. They're typically indexed to something. Um, and I had it in Europe, so it was the LIBOR, the London interbank, whatever rate. Over here it'll be, prime rate plus whatever. Anyway, some sort of index where at the end of the year the interest rate can change, and it could go down, I guess, but typically they're going to go up, and um, it's going to get to a point where it could be unavoidable or unaffordable for you. So, but the interest rate on ARMs is quite a bit less than a fixed rate. But right now, when the fixed rates are down around 3%, It makes no sense not to lock that in for as long as you could. This would not be the time to take an ARM. An ARM would be something if interest rates had gotten higher and made the home unaffordable for you. The only way you could do it was with an ARM. That would work. Caps on adjustable rates. So it's going to limit the fluctuation. Home versus rent. So, yep, renting a security deposit, owning, down payment, closing costs, maintenance, taxes. But the tax advantages and the building of equity and the freedom you have. Special types of mortgages. Not going to spend a lot of time on this. I mean, a balloon mortgage, you can have it like an interest only loan, and then with the big chunk due at the end or something like that. But anyway, I'm not going to go there. So interest only is, for me, is typically a balloon payment because usually on the balloon payments you're paying only the interest, and then the large payment is due at the end. Refinancing. So if you have a loan out there and loan rates drop considerably, like a point or two, then it may pay to have it refinanced. And so you have to pay some fees again, a few $1,000 perhaps, and redo the loan, and it starts again. Though if you have a 30-year loan, you just put it back out to another 30. But I've refinanced once, and it's not, you do it for the right reasons. You do it because the interest rates have dropped. So, all right. So let me show you one thing real quick. So these are the interest rates right now. So down at 3%. That's pretty phenomenal. And remember what I said about a shorter term will normally have a lower interest rate. So 2.4. Now, this would be kind of silly. Here you're doing an adjustable rate mortgage, and you're not getting really any savings. You're exposing yourself to a fair amount of risk in my mind for nothing. I don't know anybody who'd be doing a adjustable rate mortgage right now. Jumbo mortgages. I wonder what jumbo. Anyway, certain sites will have all these numbers on VA. It's going to be about the same. Anyway, bank rates got a lot more than just the finance rates, but you can put in your numbers right here and expect emails to follow. Here's the credit score. So all these numbers are interrelated. But in this case, they're saying 740 plus. So if you're in the 800s or you're 750, you are at the top of the pyramid here. Anyway, it's interesting stuff. We'll talk more about real estate later, but I covered a little about personal loans. Let me know if there's any questions.